everyone. Welcome to another episode of our bi-weekly webinar. Dr. Fasanya, I'm a pulmonary critical care physician and CEO of Dr. Easy Capital. I'm your host today, and we have my co-host, Dr. Ozoude, who is a direct orthopedic surgeon and CEO of Time Health Capital. And our joint goal is to empower and help fellow physicians and high-income earners achieve financial freedom and time freedom. And just a little bit about how I got started. So our team, we started in 2018 with 8 units complex. And now we have over 1,500 units, including the deals we did ourselves or partner with others to bring about the deal. We cut across multiple asset classes, including self-storages, multifamily, oil and gas, and commercial real estate. So we believe in diversification, and as long as it makes sense and I'm doing it for myself, we tend to bring it to our investors. Today, we're going to be talking more about syndications and what to look for, what to watch out for, because obviously for marketing purpose, whenever you want to do anything, people tend to focus on the positives, right? It's always, oh yeah, you're going to get cash on cash return. This is 2x, 3x. So there are things to look, basically some due diligence and need to be done, and also things to watch out for. So I'm going to pass it on to George.
Yes, thanks, Bio. George Ozoude. I'm an orthopedic surgeon based out of Houston, Texas. I'm also a real asset syndicator. Started my own journey into real estate and real asset investing in 2016 while I was employed as a physician in Houston. I saw the writing on the wall where corporate medicine was headed and was really eager to find out some passive streams of income to make myself more resilient, to increase my options. If I still wanted to practice medicine, I can choose to in any setting I can, so long as I can have my financial freedom and passive income streams. So that's what really got me started. It's to be a better physician. It's to treat my patients without any middleman. And so I went on to start my own private practice. I've been doing that for the past 2.5 years. It's a direct pay practice, so there's no insurances. So I directly interact and engage with my patients. And that's exactly how I imagined it would be when I first got into med school. And that's why I was really passionate about this type of investing, because I think it allows for that. It facilitates that. I started in 2016 investing in multiple different types of asset classes, from medical office building to large multifamily, both acquisitions and development deals. Went on to invest in farmland and mineral rights, which is a type of energy sector, and now trying to branch out into other real estate type plays and even into business acquisitions, small business acquisitions. Started a syndication company 2.5 years ago as well, to also help other physicians and healthcare providers get into the space, because I knew they were feeling the same frictions that I was feeling. And I knew some of them were like-minded and were interested in getting their financial freedom as well. And so I've gone on to invest in 4 deals as a co-general partner and about 25 deals as a limited partner, and just continuing that journey. And tonight is part of that journey. We've been doing this webinar for almost 2 years, and we're, like Bio said, real excited about the topic tonight. It talks about pitfalls. Not only we'll be going through our list of pitfalls, we'll be sharing our own anecdotal stories of our experiences and as it pertains to those pitfalls. With no further ado, I will share screen and
if you have any questions, you can. There's not a lot of us, so you can actually just raise your hand and come off mute. So
please let me know if you can see my screen.
Yep, I can.
Can everyone see it? Bio, can you see it?
Yep, I can.
Okay, perfect.
We got real asset docs.
All right.
Nice.
I'm sorry?
I said we got real asset docs now. Huh? Nice.
Yep. So we're going to talk about avoiding pitfalls. We're going to jump right into it. We're going to go into all these pitfalls, share some anecdotal stories. We always like to lead with this. This is the biggest, most important thing that, whether you're a limited partner or co-general partner, that you have to take care of when you're evaluating a deal. You can't ignore who your lead sponsor is, who your one of your most important partners in the deal is, and who's the operator. So many times we get this wrong, and it really, in my mind, involves a lot of nuanced vetting. You have to go deep. You have to be patient and really take your time, not get enamored by like a OM, which is an operating memorandum. It's like their marketing. You can't just see the pretty PowerPoint and just jump on it. You have to take your time. Don't rush into these relationships. We call it like a marriage. You got to take time before you got to date, even before you get into bed. So what I like to do is I like to go on the internet and look up different subject matter experts in the space that I'm interested in, the asset class that I'm interested in. Maybe compile a list of 4 or 5 of them. Listen to their content, because that's a free way to get familiar with them. Because usually if they're putting out content, or excuse me, usually if they're doing deals in that kind of manner, they're usually putting out content to promote their brand. So you can get familiar with these operators for free at the touch of your hands, right through your fingertips on your screen. And then I take it to the next level. I find conferences where I think they'll be going. If they're speaking, that way I can go hear and see them in person. They're probably going to attract the same people that are also listening to them. And I get a chance to talk with other people who are following them. Maybe they've invested with them. And now I can get like an unbiased review of who they are, how they perform, how they communicate, what kind of track record they have. Then you can look at their actual performance, and that should be available obviously on their website. But then you can vouch and confirm it with the network that you develop by going to these conferences and talking with other investors. You can get real thorough with it and even do background checks. You can pay for background checks and try to see if there's anything that's ominous or worrisome or concerning on their history. Preferably, I like to see investors and lead sponsors who've had decades of experience. And that's important because you want to know that they've gone through ups and downs of an economic and business cycle. You want to know they've been able to either make money during a down cycle or survive a down cycle. And even if they've had some bumps in the road, that's fine too. You want to know what they've learned from those bumps, right? I like to see that they've gone through at least a decade or two of investing. And that way I can feel a lot more confident about their performance and who they are, their character. By anything to add on that?
No, we have that list of 101 questions. You can download it on my website. Questions to ask the sponsors about the deal, about the area, and how to vet the sponsors.
Yeah, for sure. And example, I think for me, I think about is in this past cycle where there was a lot of rise in interest rates, a lot of really well savvy, experienced investors, they actually went pencils down. A lot of them stopped looking at deals, not just because they magically predicted interest rates would rise that high or not. I don't think anybody really could have predicted that. But I think what I've heard is that they also saw that a lot of these deals, specifically multifamily, were being overpriced. They were being overvalued, and then a lot of them were being won by taking out variable rate debt for the actual deal itself. And so I think the real savvy ones, the real well experienced, saw that, and they didn't even have to predict the rate hikes. They just saw that alone, and they were like, all right, the market's too hot. And that impacted me because I had to learn that. I had to invest with some not bad investors, not bad operators, but they still didn't recognize that those variable rate loans were problematic. And we got caught. We got capital calls. So I've been involved as an LP in some capital calls, right? And when I go back and look at it, I look and see it's actually the debt, the overvaluation, the over leverage. And some of those we'll talk about that as we go on. But I think savvy investors pick up those cues a lot easier. Okay, so then we have misaligned interests. So, Bayo, you want to speak on this one's important.
So we always talk about having to align your personal interests with your personal financial statement. So you need to have your own goal, you know. So, you could be as detailed as you want. You could be really get to the level in which you be like, I want to only invest in something that's protecting the environment or something like that. We have someone that does syndication where they use all these environmentally friendly paint. So you can be as deep as that. Also, in terms of, are you into the cash flow? Is that what what your interest is right now? Is your interest in doubling your money? So in which you're focused on equity. So you do more development deals. Is it so that's what determines what kind of how you invest. And also you have your own portfolio division, like, okay, I want 50% here, 30% there, 20% there. And so just make sure the sponsor's interest is aligned. And also another way to know is also that preferred return. I don't think we see any deal that doesn't have preferred return now. In the past, we used to see that if you don't get your cash on cash now, oftentimes it's gone. It does not carry over. But almost all the deals we do now, have that preferred return, which means the sponsor does not make any money until you make that percentage. So if your preferred return is 7%, if after paying all the expenses, now you only have 5%, it means that investors get that 5% and the 2% get carried over. And when you sell, the investors get that 2% before they split the remaining of the equity. So that helps you know that, okay, now these sponsors are going to work hard, also make sure that they're also investing in the deal. And like we said, make sure they invest more than than their, not like a little bit, but not more than just the earnest money, if possible. Yeah, so that's what it is. So just make sure that's part of just vetting the sponsor, but you can notice those things in the deal itself, in the operating
I
agreement.
I also think about like just the return profile. I know you briefly mentioned like whether it cash flows or not. And then when it cash flows, I learned by being an LP that the 8% that they claim on a offering memorandum on the marketing package doesn't necessarily mean throughout the entirety of the deal from year one. It's actually an average, and that may not be obvious and when you first start investing. So you think you might be getting 8% every year, but it averages, maybe it's 4% year one, then 6% year two, and then 9% year three, and 11% year four, and it averages out to 8%. And this impacts your plan. If your plan was to accumulate a certain amount of cash flow per year to replace your income and get financially free, you have to take into account that these things are sometimes backloaded, not front loaded. And you want to make sure that your goal is aligned with the deal's goals. I know the slide here says sponsors, but I also think the deal, you have to understand which asset classes have that typical profile where they cash flow on the back, or they get you most of your return on the back end, versus other deals might get you a lot of return straight out the gate. And so you want to make sure you understand that and you're aligned with the deal itself and the asset class, so you're not surprised. I see that in some of our community forums where investors are like, it's year two or year three, and I didn't get the return I was expecting by now. And it totally may come on the back end, and that even happened to me. There was a deal that I was expecting cash flow, but it just had so many challenges that we didn't get anything until the end when we sold. Now, they met their numbers, they met their marks. We actually hit all our projections, but it all came on the back end of 2.8 years. So whatever I was planning for those 2.5 years, that's out the door, even though actually the investment did quote unquote well. So that can be a little bit of a friction or confusion that you want to make sure you get that right in your mind prior to choosing to make an investment.
We can answer this question in the meantime. Faith asks, in general, is it appropriate to ask why the sponsor is also not invested? Absolutely. This is your money. And so I would say don't be scared to ask. First and foremost, of this is online. It's not like they're going to do anything to you. So just ask, call them, because you're investing 50K. It's not an easy money to come by. So yes, you should ask all the questions. And if they're not trying to answer your questions, you can take your money elsewhere. In general, we actually always have to invest in our own deal. In fact, we didn't do some deals because I didn't have enough money to invest. And that's why I turned the deal down. And George has the same thing.
Same thing.
Sandy Ridge is I don't have money to invest, even though I'm investing in it. And even though I can carry both of us, but he still has that belief and ethics that, look, if I'm not personally investing, even though I know our team is investing, but I'm not personally investing, I don't feel comfortable doing this deal. So I think that's like easy thing. If you believe in it enough, you should.
And then to that point, we can take it even further. You can look at things like how the splits are. Sometimes that's industry standard 30-70 split, 30 going to the team, the main team, and 70 going to the larger group of investors. So you want to keep that in mind. That's usually about the balance of what, and that's how it should be. The majority of the money should be going to the bigger group, the limited partners, because without them, the deal's not happening, right? Sometimes it's 50-50. Sometimes it's 80-20. Sometimes it's 90-10. And that can mean different things. If it's 10, that means the general partner group might be getting so little of that deal that they're just not motivated to execute. Especially if it hits some rocky road. If it's fine, if everything's going fine, yes, then okay. But what if it gets a little headwind? Are they still going to be motivated? Are they going to be aligned to go through that headwind and get to the other side? So watch out for the splits. 30-70s industry standard, 90-10 is a little too skewed towards the LPs and not enough perhaps towards the GPs to keep them working. And then 50-50, you're going to have to make a decision. Do you feel like that's satisfactory to you as an LP if you're going to give 50% of the gains to the GPs? You're going to have them very motivated though. So they're going to be aligned to get the whole deal done. But are you satisfied with giving up that much equity for them to be motivated? Personal preference, but at least the industry standard. Okay, over leveraging, excessive use of debt, which can increase the risk, particularly if the market turns or the property underperforms. Yes, you can look at this even before you make an investment. It's something that I hadn't looked at when I first started. I was more of a big picture, look at the macroeconomics, look at the market, the economy, the job creation, the migration patterns. But you get burned if you don't look at what the debt structure looks like. If they're taking out 85, 90+% debt and only 5-10% equity, raising capital, that's a little shaky, especially if it's variable rate loan. As you can see over the last 3 years, this is one of my biggest personal pitfalls. I can relay it in person because I've invested in many deals that were structured like this with variable rate loan. Luckily, half of them are still doing okay, but the other half have definitely experienced capital calls, and it's something I'll never forget. I'm always going to look at the debt. I'm going to look at the terms, and I'm going to look how much debt they're taking, how much equity they're raising, if they're raising more capital than they need. And we'll talk about that later. How long do they have to pay off the debt? How many years do they have interest only? You'll hear that term a lot. These are all important. And then of course, what the interest rate is, if it's fixed or if it's variable.
Yeah. So for investing, it's a little bit different than personal property. On the personal side, I can over leverage only because I know my capability, right? So for example, there's a bank in town, Kyle knows, First Star Bank. They will give you like a 90% LTV or 85% LTV on the deal. What that does is you're bringing less capital in, right? But now almost all the money is going to be going into paying the debt. So you already, in that kind of a deal, you're already basically banking on the equity, not on the cash flow. So in that way, you just have to know what you're doing. And so, but then if you lose 10% value of the property, then you have to put in more money out of the pocket to exit. So 80% is, and now it's actually almost like about 70%, for most deals now, which you want 30%, you put 30% down because you can make more average return by leveraging more, but then you increase your risk. So there's no risk without, you have to basically take risk to get more return, take less risk, your return would decrease, but it's more sure, right? It's more stable. So you just have to look at it. And also we talk about alignment. if you look at it and you say, look, I'm in my early 30s. I mean, I'm late 30s now, but when I was in my early 30s, at that time I was going for higher risk. Even I still do so. But if you're in your mid early 50s, so it's going to be tough for you to recover now. So you definitely have to go for more of conservative deals. So it's just the way as stocks, right? When you started in the beginning, so high stocks, and now you start doing more bonds. So
right. So one thing that was a little bit of a intimidation for me was like understanding the language behind like looking at debt and mortgage and that world. What bio for you, question for you, how did you learn how to speak this language of like mortgages and loans and debt? What resources can someone use to get more familiar with the terms and the words?
I did have a mentor who basically went through things with me, almost like a class. So he would go through things with me. And also I consume a lot of webinars, videos, books to learn about this. So it's something, yeah, it's like going to undergraduate. It took 4 years. It's going to take you some time to finally
Med
get it.
school.
Yeah. And there's many things that I also did. I look back into 2018, some of the things I did, like you yourself now, and you're like, I can't even believe I survived that. It
And I
happens, but
and
you learn as you go.
And I admit that's probably a reason, probably why someone would avoid or be discouraged about looking into it in depth is because we may not understand it. You may not understand the terms. For me, I used Investopedia. That's what I started with. They give a lot of good definitions. Um, I also went on to certain podcast platforms that I felt like were better for beginners. So I thought Bigger Pockets was better for beginners. They broke terms down that in a way that I could understand it. The real estate guys, they also do a good job for that beginner level to understand it. And then now, since there's the advent of AI, I think ChatGPT and other AI platforms, you can get on real quickly and just talk to it like you're talking to an advisor or talking to a experienced real estate investor, and they will break stuff down. You can even prompt it to tell you to break it down to me at the level of whatever you're at, a beginner investor, and you can learn these terms and get more comfortable with vetting them and not allowing it to be a pitfall. Okay. Unrealistic projections. So relying on overly optimistic financial projections, which can lead to unmet expectations of financial losses. So what I think this is really exposing yourself to as many deals as possible, not doing them, but just at least looking at them. And that way you can start to get a sense of what are typical return profiles based on the asset class. Like large multifamily is cash flow is like 6 to 10%, and average annual return is 20%. This is like what you would typically see, like an average. And so if I see something that says this value add or this value add multifamily deal is giving me is going to offer 25-30% cash on cash return, I'm like, that's a red flag. Like, because I know you've already become familiar with what the industry standards are, like what we were talking about before with the splits, with the other things, there's industry standards. So look at as many deals as possible. Even if it's stuff you may not invest with, take the time. That's why I say you have patience. Take the time to go through a deal every day if you can, or two deals on the weekend if you can, and just talk to other people, go to the conferences and find out what their typical projections are for oil and gas deal or for a self-storage deal. They all differ. So you want to be able to know the difference and know when you're seeing something that's abnormal.
Yeah, but I took some screenshots, but I didn't put it there. Yeah, so every time I see a Facebook ad that's that over projecting, I always screenshot it and send it to George. He's like, I've seen things like light value add, 35% average annual return, 2 years. I'm like, 2 years to do your business plan and return that much money. Really, you're setting yourself for failure for most part.
Right. And then the pitfall also could just be if you're looking for the home run too much. And this is personal now. You got to decide which game you're playing. Are you going to swing for the fences and get starstruck by some of these big numbers, or are you going to try to hit singles and play the slower, longer game? And that's typically what real estate syndication is. It's not like a get rich quick. You just have to slowly chip away and keep compounding your returns and then reinvest. Hey, if you're trying to swing for the fences and you want those big of a returns, then it's just a personal decision at that point. Enter at your own risk, though.
I think if you want to swing for the fence, just go for venture capital. You go for business startups. In real estate, it's usually a base. I think when I think about financial pyramid, I think of real estate to be the base, the bottom. Like everything falls, you fall on it. But if you're now making your real estate that be that risky, like at the tippy top, then that's not going to end well. But you can make it a percentage too. You can be like, look, I'm going to do 10% of my portfolio. So there are people that believe you should do that too. 10% of your portfolio for asymmetric upside plays. But I would say once you're just first getting started, you should just play it safe as much as possible. And then once you reach financial independence, maybe you can start taking more risk.
Yep. All right. Bio talked about this earlier, so I'll let you go in on it and continue on this one.
For fee structures, we talked about it before. We came up with this arbitrary 5%. So basically just know that I've seen some deals. By the time I look at the actual PPM, you get basically fee to death. There's always acquisition fees. We know about that. We know asset management fees, and we know exit fees. So those are three that are common. But with construction, sometimes you have another thing like development fees. They might have 10 different fees. And sometimes when you add them all together, the fee might be like 10%. That's like a big chunk of the return that you're going to fees. So I think it's good to know industry standard. We go back to that again. And of course, everybody loves the middle ground. So acquisition fees is usually, some people say 1 to 3.5. So if you see a deal that has it at 2%, you're like, okay, reasonable, or 2.5. And then asset management fees could be 1. And then exit fee might be 1 or 2. So when you put them together, it turns out to be about 5%. But if you're starting to see 3.5 acquisition, 2% asset management, and then 3% exit fee, and then 3% development fees. So you're like looking at fee, too much fees. And then that's just something, and the fee, it goes to the syndicators regardless of what happens. That's the problem with the fees. Regardless of whether the deal does well or not. I guess the exit fee, you get it only if you make money at the end. But management is being taken every year, and then acquisition fee is being taken as soon as the deal closes.
Yeah, I agree. And I look at that acquisition fee even closer to make sure it's not front loaded. It could be 4% acquisition fee or 5% acquisition fee. And then you see these smaller management and exit fees. What that means is front loaded for the operator. And so I'd like to see them kind of show me that they're incentivized to execute throughout the whole deal by backloading their payouts, right? Not only are they going to make money from their investment, because remember, they need to be invested alongside you in the deal, but then I want to see that their fee reflects that they're going to be rewarded on the back end as well, right? So I'd like to see it at least even distribution, if anything, and then weighted to the back end. I don't like seeing it front loaded. So as long as they just put that means as long as they put a pretty PowerPoint in front of you and collect your money for a capital raise, then they get a big chunk of it right out in the beginning, and they haven't performed. They've only performed the capital raise part. They haven't performed anything else. Well, that's not true. They sourced and acquired the deal, but there's still much more to go. They have to execute the management, the business plan. They have to manage any headwind. They have to exit. They have to sell it at a good price. They still got work to do. So I don't like seeing it front loaded on the acquisition fee. Okay, poor market analysis. So this is where I didn't struggle in the beginning, but it could be an issue if honestly, if you're just really not doing any work. Bayo and I say there's nothing that's really passive, that's truly passive. That's just if you give your money without looking at some factors and some key metrics, then that's just reckless. You have to at least, and this is not hard to do. This is probably the one of the easiest. You have to at least look at some market dynamics. And again, you may have to take some time first to learn the language, but that's fine. There's plenty of resources out there to learn what economic indicators can tell you about where job growth is going, where population growth is going, where local rules and laws and regulations are lax versus strict, and how that it can impact investment decision. Yeah, you can look at all of this. And if you invest in a small, very small town that has one sector that does just oil and gas, like Midland, Texas, and you try to invest in the down market in the oil energy sector, yeah, your deal's not going to do well because that's a one-hit wonder type of town or a one-trick pony type of town, and they don't have any other economic support. So this is something that I think is beginner. You have to understand this part and look at it. And there's many resources out there. Bio don't have anything to add, then we'll go on to the next one. This is one I've learned recently. Capital reserves. It's one thing to raise a certain amount of down payment, and then obviously you get the rest from the bank. But then there's actually some more that you have to raise and bring to the beginning of the deal beyond those two initial things. You have to have some reserves to operate the deal. And what I've seen in some of my deals that I'm in is that there just wasn't enough reserves raised. And once headwinds started hitting, the capital ran out really quickly. The capital ran down really quickly to the point where they could no longer make distributions or even hold on to the deal. They have to sell it at a loss. So being well capitalized beyond your down payment is actually very important, especially over the last few years. That's impacted a lot of deals and a lot of operators. We've learned a pitfall of how capital is distributed in the deal, your extra capital. You can hold it yourself as the operator in the bank account, and that you can tap into and access anytime, or you can have it as a loan from the bank, which comes with some restrictions or some processes that you can't just get it right away. You have to draw it, and you almost have to, not almost, you have to actually front it with whatever capital you have and then get reimbursed on the back end. And this can take many different twists and turns, as we've learned in some of our deals that we're general partners in. So it's not as easy as just going to the ATM versus if you have the capital reserves in your own separate independent bank account.
We definitely learn. Well, we basically raise just on our in our own bank account now, and not use the bank. Before it used to not be an issue, but I think because the bank has tightened down, so it makes it difficult. I've done deals before, personal deal that they basically give 100% for innovation. And when I ask for the money, they don't even go check it. They just say, okay. And then when it was done, they inspect it and then it was done, over. But now they have to go check it every single thing you do. They go check it. So that's just something. The problem with this is the more you reserve you have, the less the deal look attractive, which is funny. So when you look at the underwriting, so for example, the deal we have right now, we have like about $1 million in reserve, right? So having $1 million just hanging out in the account put what is called a cash drag on your investment, but it's for safety. So instead, if we cut that down to maybe 300K, the return for that deal will have been like 25%. You know what? So, but because you have the reserve, the capital is not really doing anything technically, because there are deals that we have the reserve there, and the reserve just stay there to the end of the deal. You try to put it into like high savings account, something that give you like 3%, 4%, but it's not going to be the same as working hard for you like a syndication, that money. So, but it's for safety. So it's better for you to do a deal that will be like 18% return but they're very well capitalized. So always overraise is what I would
Yeah, and
advise.
you can ask that as an LP. You can ask, what is the capital reserve? Where is it going to be held? Is it going to be in a high yield savings account? Is it with the bank? Is it with the lender? Is it going to be drawn upon? Is it a reimbursement? Those are all valid questions that you can ask a lead sponsor before you decide to make an investment, because it can have an impact.
Yeah. Also, there are things that happens, right? Let's say we have one of our property we have a fire issue. So right now we're still fighting with insurance to get the money. So technically you can decide to fix it if you really want to. But that's a question you have to ask, that do you have enough and would the insurance company pay you back? Because they might fix it and they might be like, we're not gonna pay you. So anyway, so you have to make your own, but if you have a good reserve, you have a lot of, you can maneuver much easier.
Right. So inadequate legal protections. So not thoroughly reviewing and understanding the legal documents such as the PPM can expose investors to unforeseen risks. And I think this is important because the PPM is actually the legal document that, really sets the terms of whatever is going to happen with that deal. You can see X, Y, and Z type of marketing in the PowerPoint, but it doesn't mean anything if it doesn't make it into the PPM. And some of these PPMs can be very big. And so a pitfall is to glance over it and not really pay attention to what's really written in the PPM. For the first few ones, for all of them, obviously, read all of them, right? That's what everyone says. But the reality is some of these are 100-page long. And so I think it's at least important to, if you're going to do a lot of these, if you can't read all of them, which I still recommend, is you start creating kind of systems of at least looking for the important parts that you want to see every time in every PPM, certain clauses and certain things in the operating agreement that spells out the roles of the LPs and the GPs, that kind of details out some scenarios of what ifs and how things would transpire if it meets some headwinds. You want to see that. You want to look for that. And I think with the type of documents that we get electronically now, it's easier to search those things. You can get on the DocuSign and hit Control Find and start really peeling through the PPM if you can't spend 5 hours reading it on a Sunday afternoon. Anything to add to that, Bio?
Yeah, and also, I mean, make sure that at least they have you can get PPM online, you know, at least I will hope not, that they actually have a CPA. You can ask the CPA. You can ask who's your CPA, who's your lawyer, SEC lawyer, that does this, that drafts the document, you know. So, and you want to read at least the summary of it, and also want to find some few things like, do I get a vote? I always want to know that personally, if if there's a change, and also I want to make sure that all the syndicators are mentioned, in the PPM. So yeah, just this is I know people are not going to read it because it's 125 pages, but try your best.
Yep. Okay, overlooking the exit strategy. So this definitely can be a pitfall, not having a clear exit, and maybe not even just one, but two or three, alternate exits if the option number one doesn't work. But not having it can make it difficult to realize the profits that you were promised or projected, not promised, and or recover invested capital. Yeah, I'd like to know that the deal has more than one way to make money. We have a primary way, that's fine. But if that doesn't work, what other ways? And another point about this exit, there's something called a cap rate, which determines the value of the property in respect to how much money it makes in NOI or every year. And so a lot of cap rates are projected at the end of the deal. And I want to see that the underwriting shows that the cap rates are conservative, meaning that they're not just assuming that the deal is going to exit at a lower cap rate, which means that it's going to exit at a higher valuation. I don't want the deal to only work if they just assume that the cap rate will be lower on exit in 5-10 years. I want to also see that the deal underwrites if the cap rate stays the same, or even if the cap rate gets a little bit worse. That means there's room for error. And so just assuming the market will always go up and the cap rate will always fall is a pitfall for both LPs and GPs. So be aware on the documents, ask for the underwriting, get familiar with doing a little basic underwriting, or even have someone help you do it. And you can even play with some of the spreadsheet and put in a higher cap rate on exit and see if the deal still makes the cash flow that it promises, if it still makes the average annual return that it promises, or if it makes a return, because it's going to go down as soon as you increase the cap rate. But does it go down so much that you're no longer attracted to the deal? You need to know that, because that could be the scenario. That could be the reality, right? It could actually, and that's what's happening now. People are exiting right now at higher cap rates than they projected 3, 4, 5 years ago. A lot higher with the rise in the interest rates.
So you just want to look at sensitivity analysis. George and I always want to be like, what is the highest cap so that I just get my money back? Sometimes we keep pushing it. Let's say you buy it at 5 cap. Sometimes we even do the sensitivity analysis all the way to 8 or something like that. Like, what happened? What is that break even? Where is that in the worst case? And you want to make sure that they do some, at least they put some effort into doing you should see that in the slide deck actually. So, which they should do the sensitivity analysis to see, they put the middle one. Okay, it's most likely going to be 2x. But if we go higher cap by 1, it's going to be 1.8x. If we go another cap up, it's going to be 1.6. And then until at one point, it will be like 1.2. But at least you want to make sure that it's far away from where we are now.
Yep. This is one of the most important things. We wanted to include it. This is not necessarily like a pitfall. It's hard to look at this and try to figure this out as an LP in the beginning of a deal when you're being offered an opportunity. But there's some questions you can at least ask. And we wanted to share this slide because we want everyone to know that this is one of the most important things. You could have a great operator team, a great syndicator, but if they have a poor property management on site, managing the deal, that deal can definitely struggle. So having a really good property management team is important. I like to know if the operators are experienced enough to bring in a property management team, whether it's in-house or a third party, but if they bring them in, or if they had brought them in at the beginning of their process, before they even got the property under contract, did they invite the property managers to come do diligence with them? Or if they just brought some random third-party property management team on at the end of the closing. If they don't have it in place already and they're already raising capital, that doesn't look good to me. Those are not good optics. That means they're just going to try to back into a property management team after they've already done their assessments and their projections. And a property management team can come in and say, look, that all of that you did is not going to work because we know the market. You thought you knew the market, and that's not going to work. And so now you have a problem, right? Because your business plan, if you only had one plan, it is not going to yield the results you wanted. Definitely worth mentioning. Still some questions you can ask on the front end so you don't make that pitfall.
Even on personal property, I bring my property manager is also a real estate agent. So try to do both, try to find me deals and then go do the due diligence. But if you don't have that, you should definitely have a team. I even bring contractor. So I have, there's one big day that we go check on the property. It's going to be I have a construction by contractors. You have a property management, and then even the inspector, and then you all go around the same time. And so it's important because there is some deals that I sent to my property manager, due diligence person, and immediately I sent it. Oh, I've worked this property 10 times already. Those are like some of those local things that you don't even know, right? I don't live in Tulsa, but I got a property in Tulsa. Everything looks so great on paper. I sent it to her. She's like, I worked it like 10 times. Like, this is not a good deal. So that's it, So you want to get them involved very early.
All right, we are towards the bottom of the hour, so I think we only have a few more. Overpaying for the property, we talked about this before. A good operator is going to know when it's time to hold them and when it's time to fold them, when it's time to underwrite and when it's time to put pencils down, when everyone's entering the market, when doctors are syndicating. I'm joking. That's when there's cycles, right? There's ups and downs in the cycles. And when everything's hot and there's just overvaluation, then this can be a pitfall and there are times to just pull back. And I think that's super important.
It's the same thing for almost all the asset classes. When your grandma is talking about crypto, that's when to sell. when you hear like that doesn't even know about syndication talking about it, then it's overheated.
Yep. All right. I think we have some questions.
I think we're ready.
There are other points too, but we just wanted to at least bring these ones to light. We thought these were really important ones that we can speak on from personal experience as well.
And it's interesting that it doesn't matter. You might be in this business for 20 years and you're still going to learn something. So being a real estate syndicator is a humbling experience for many things, like something that worked before and suddenly doesn't work again. You continuously just learn, adapt yourself, and do as much due diligence as much as you can. There's still going to be things that you cannot control for, but it's one of those things that I used to say that it's on you. If it's like when you go for an exam, I always say, I'm going to make sure I get all the easy questions right. Okay, so now I only have to worry about the 10, 20% that are hard questions. But if you're missing the easy ones, then you're going to fail. So I feel like the easy, low-hanging fruits, make sure you get all those down. And then so that at least then you can focus on the challenges that you get after that. But if you're making like a silly error, it's on you.
You're either going to make money or learn a lesson. That's what I say.
Yeah, hopefully not lost too many.
A lot of lessons. All right, guys, any questions? You can come off mic. You can leave them in the chat.
We do have some syndicators, Billy's and Little Rock Market. Right.
Hey guys.
Yeah.
Yeah, I have a question. So when you're looking at deals from the LP side, do you like to see more than one general partner? And if you do, how many do you think is too many? What's the ideal scenario for you?
That's a good one. I do. I think it's a team effort. I think knowing what, and this is coming from someone who knows a little bit more about syndications, and I almost have to put myself in the shoes of an LP who's beginning, but knowing how much of a heavy lift a syndication is, especially the type, if it's a large multifamily, I think it's a team effort. You got to have folks who are splitting up some of these duties. There's a lot of different things going into it. So I do seeing a small team. I do knowing that the lead sponsor is able to run a team because we're part of the team now as LPs, a specific part. But I like to know that they can interact with other stakeholders and other entities and can do business and figure out how to work together for a common goal. So there is a limit. There's only so much that can be done by the general partnership team. And so when I see too many over 4 or 5, I start to get concerned. I think that's probably your limit. I think above that, you just have a bunch of people who are just piling into the general partnership. Almost it's bad optics. It takes away from the quality of the deal. They have to bring in all these co-general partners and capital raisers to raise enough money for the deal. So that to me, it starts to become a red flag. I know all those cooks in the kitchen can't possibly be contributing to the business plans. 4 or 5 is what I would say.
Yeah, I think there are some deals we don't get on also. And when we look at it and people are raising like 500K, 250K, like why do you need so much smaller capital raises? It's better you go for, if you need 5 million, find 5 solid or even 3 solid people that can raise 1.5 each or 2 million and then get those. And also, yes, there's voting. There's going to be voting. there's more likely for you to have disagreements and stuff. And the bigger the team, the more likely that the team was just put together, that they don't know each other before. So it will be like, oh, we need 500K left. Don't get me wrong, I've put something like that before too. If I'm running low on raising capital, but it should not be something that it's like all the time, so that you suddenly bring people that you don't even know, so you're not going to work well together.
How do you know how all those random people work well together and protect all the LPs' money?
Like 10 people, and then you're like, so
yeah. And that's a great point, Steve. I would say not just how many, but like how long have they been working together? Like that core group, do they have the collective track record? Are they piecemealing the track record, or do they have like a joined track record? Like they actually have 10 plus years together. That 4 or 5 people been running deals 10, 15 years together, or did they just come together last month?
Yeah. So yeah, sometimes you won't even know that's a problem with some of the syndications. They will come as a fund. So I guess they're technically LP, right? If they come as a fund of fund.
That's an LP. To me, that's different. They have the same rights as any other LP. They're not in the GP making decisions. Of course, read your PPM, make sure that's what that says, but that's how it usually is. But yeah, if it's fund of funds, then they're just coming in as a very large LP partner.
Yeah. Some people will come in with big money, right? With I have $1 million, can I get extra reference?
Ryan Johnson said, great point. So I'm curious because I was running the PowerPoint. Which one was that?
That was about taking a look at the cap rate and what happens if it rises and how that correlates to percentages for your return. I thought that was a really great point. I've never thought about that, to be quite honest with you. So thank you for that. I did have a quick question though regarding the PPMs that you mentioned. You guys have been doing this for a while. When you get these contracts, you know what's boilerplate, what's not. What do you typically look to first? I know you mentioned you do a control F for some pertinent terms, but where do your eyes generally navigate to first in some of these PPMs?
I look at the rights of the LPs. I go to see what they are, what their voting rights are, what controls that they have, what they don't have. I look to see that the returns are matching the PowerPoint that they were presented. The debt terms are matching the PowerPoint that they presented. And usually they have an executive summary where they put everything in one place. That's one thing to look at. I look at what happens if the lead sponsor becomes incapacitated. I want to know what the pathway is is it somebody within the team, or do they have to bring in a new person to run the deal if something catastrophic happens to the lead sponsor or their team? So those are things that I look at. I go directly to search for. What about you, Bayo?
Yeah, I mainly go for the summary first. There's always that summary that states everything, so you can have all your numbers there. I want to make sure that's where they actually write the team members. They write their track record. There's always a little bit of blurb about each one of the team members. It would be good to at least take a look at that, because during the slide deck, oftentimes it's only just like the picture and one paragraph. But for that, they usually tend to put a good picture of the story, what kind of asset classes they've been investing in the past, and things like that. And mainly just to make sure, like Josh said, that it matches. You won't believe it. There's many times you'll say 25%, 30% on the slide deck, and then you look at 18% on the PPM. So you want to make sure that the fees too. So the fees, you can type in acquisition fees, it's going to come up with it. Type in asset management, it's going to talk about that. Type in exit fee clause. Yeah, so those are the main things. We probably should come up with a list.
Definitely.
But I also look in. Provide most of it though. The summary will provide most of it.
Okay. Yeah, I also look and see if there's any private equity ahead of the LP on the capital stack. I feel like sometimes it's not clear that they're bringing in a very big capital partner and where they sit on the capital stack. That's something that I've recently been looking out for. I feel like I had been missing that in my earlier deals. I didn't even consider it.
Yeah, price equity
but-
for sure. Yeah, they almost always sit in front of you, and then you want to see how the distribution goes. Yeah, basically just confirming that what they told you was correct. Because if you're going to sue each other, you're not going to be able to use the slide deck or anything else. You're going to be using the TPM. So that's a legal document.
Oh, good question. All right. We definitely want to be respectful for everyone's time, and we want to thank everyone for coming on. If there's no other questions, we look forward to seeing you all again on our next webinar. It's going to be in another 2 weeks. And if there's no other questions, I think we'll close it out. What do you say, Bio?
Yeah, thanks for coming, everyone. See you next time.
Thank you, guys. See you next time.